This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
After waterfall selling and a rally for the ages, where do we stand now? Up next, the odds of worst-case scenarios have gone down, but dangers are still very clear and present. In a recovery that may have come too far, too fast, continued patience and discipline will be paramount. Let's discuss. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Another very eventful week, as if we haven't had eventful weeks so far here in 2025. This time, most of the news was emanating from Capitol Hill, where, of course, the House passed their version of the tax policy, the tax bill. We'll see what the Senate does over the next few weeks. But before I get into anything and sort of what's going on, I did have an observation that really highlights a lot of what I've been saying for some time. Get this. This is according to FactSet. If you just had missed one day this year, that epic day when the S&P went up 10%, as of Monday, the return for the S&P 500 for the year was basically flat, give or take a few tenths of a percent. If you just missed that one day, it dropped all the way to negative 8.1%. That was just one day. So what have we talked about? Trying to time the market, as many individual investors attempt to do, is very challenging. And even if you do it in moderation, maybe you don't go from 100% stock to 0% stock, but even in moderation, you're going from 100 down to 70 or 70 down to 40. Those types of moves, if you miss a couple days or you get the timing wrong, you could wipe out a whole year's worth of gains. That's not to say that you shouldn't adjust your allocation, take some chips off the table. That's not what I'm talking about. I'm talking about big sweeping moves where you're hoping to avoid risk and maybe get back in later. Very difficult to pull off. I'll leave it at that, but I just thought that statistic was so eye-opening, I had to share it. But listen, what's happened in the past few weeks is in rare company. I mean, the S&P, as of Monday, of course, the market backed off a bit later in the week, but as of this past Monday, the S&P was up 19% in 27 days. 19%. That is a rally for the ages. Again, according to FactSet, if you go all the way back to 1950, that's the 15th best 27-day stretch. We've talked a lot about market behavior and how even though the catalysts for various downturns may be different, obviously 9/11 is different than .com, different from financial crisis, different from COVID. The catalyst, the why behind something might be different, but the what and the how, the actual market patterns have been consistent. So we have seen this before. We have seen big rallies like this before over 27 days, but this certainly stacks up as one of the best since 1950. And what's important about this is not just the extent of the bounce, but with the exception of that November-December sell-off in 2008, when Lehman Brothers collapsed, all of the other 13, biggest 27-day moves since 1950 have occurred at the start of new bull markets. New bull markets. So, in other words, it has not been like a one-hit wonder. In fact, in every one of those prior instances, with the exception of that 2008 period, the S&P would be higher 1 year later with an average total return of 41%. Now, I'm not making a prediction that the market's going to go up 41% over the next year. I don't think it'll be anywhere close to that, but it's not a sell indicator. Let's put it that way. Okay, just a couple other factoids just to chew on that kind of highlights the extent or the historical kind of magnitude of what we've seen. If you look at sort of real short-term momentum indicators like 20-day highs, Strategas noted that nearly 60% of the S&P 500 traded to a new 20-day high, which is the best reading since late 2023. That is very significant. When you pass the 55% threshold, future returns on average have been very good. A lot of people might suggest, well, have there been any negative signals, any false signals? The answer is yes to that, but they're few and far between. So again, according to Strategas, if you go back 50 years, there were three false signals. 2001 and 2002, which of course was the collapse of the dot-com bubble, and then again in 2022 when the Fed was taking rates basically from 0% to 5%. And since 1950, there were only two examples of a 15% decline, like we got in April, a rally that recovered two-thirds of the total decline, which we've gotten, and then a return to new lows. This is significant because one of the things that you often see with a big sell-off is a sell-off, a bounce, but then a retesting of those lows. Well, this historical data suggests that that doesn't need to happen necessarily. Can't rule it out, but doesn't need to happen. And history says it maybe won't happen. We'll see. Speaking of breadth, the number of stocks doing well, there's a thing called the DeGraff breadth thrust, which market strategist Ned Davis kind of named and pioneered. We've seen that in terms of number of stocks participating in this bounce. The S&P 500, when this breadth thrust triggers, is higher 6 months later by a median return of 8.5% with an 85% positivity ratio, and higher 12 months later by a median return of 16% with a 93% hit ratio. This is according to Ned Davis. I think you get the picture. I'm not going to belabor the point. Bottom line is what we've seen recently is more of a bullish indicator than a bearish indicator. Okay? So think of it that way. And just in general, I think I may have referenced this data a few weeks ago. I apologize if I'm repeating myself. But, the guys up at Municipal Management have been saying, and I've been saying, that a double-digit drawdown, particularly in the first year of a new presidential cycle, is kind of par for the course. Again, regardless of the catalyst, regardless of tariff policy or what's going on Capitol Hill or Trump or Biden, it's par for the course regardless of who's in office. In the 41 years since 1950, according to them, where you've had a double-digit drawdown at some point during the year, the market's finished higher almost 61% of the time. And of those 25 years with double-digit drawdowns, where we ultimately finished in the black, 16 times the market ended with a double-digit gain. Let's think about that for a second. Not only is a double-digit sell-off the norm for the most part, but it does not preclude you at all from having a still quite good year in the S&P 500 and maybe even a banner year in the S&P 500, maybe even a double-digit year. So, again, I'm belaboring the point a little bit, but I just wanted to make sure that you understand the magnitude of the move that we've had and how it doesn't necessarily mean that, this is just a dead cat bounce and that we have to go back to the lows, that the next 6-12 months have to be lousy, that we pulled forward too much good news into the present. It doesn't have to be the case. I will say, though, that if you are a more sort of diversified investor, because let's face it, most people are not 100% stocks, nor should you be in many cases. I don't want to give any blanket advice, but most retired clients, most people that have some net worth are not going to be 100% stocks. If you look at 60-40 portfolios, portfolios that are 60% stock, 40% bonds, again, the folks up at the Ritzold Asset Management noted the other day that you're expected with that type of allocation to probably fare a bit better in a bad stock market. So whereas there have been 44 double-digit drawdowns for the stock market since 1950, there have only been 8 double-digit drawdowns for those with a 60-40 portfolio. And that's what we saw here in April, right? When the stock market was down, I think, almost 19% from peak to trough. If you had a 60-40 portfolio, much less so. Bonds actually rallied during that time period. But the trade-off is your recovery could be slower. In fact, in instances where we've had a double-digit drawdown, it can take as much as 29 months on average since 1950 for a 60-40 portfolio to get back to the previous highs. I'm not saying that's going to happen this time around, but those are kind of the fleas that come with the dog, right? A balanced portfolio, as Ritzold notes, mixes the tortoise with the hare. Yes, you're going to probably outperform when things are coming down, but you also may be a little bit slower to recover if we get sort of a V-shaped, bounce like we did coming out of COVID and to a lesser extent so far over the past few weeks. It reminds me of a couple of quotes that I keep in my desk. One is from Jack Schwager. He's a famous trader. He said once, "Amateurs think about how much money they can make. Professionals think about how much money they could lose." So it's not just about maximizing return and sort of not acknowledging the risk side of it. We only know that the market has bounced like this in retrospect, right? Flashback 3 or 4 weeks, I don't think there was anybody that thought we'd bounce 16, 17, 18% in just 2 or 3 weeks, okay? Nothing wrong with worrying about how much you could lose, okay? Secondly, read another quote. Again, I keep it in my desk. Her name is Meg Bartlett, works over at Flow Financial Planning, and she said, "I'm not persuaded of the merits of optimizing." And by optimizing, what she means is, having your portfolio positioned in the exact right place at the exact right time. Like some people, if the stock market's doing better than the bond market, they'll optimize by, going all into stocks. Or if certain sectors are doing better, they will optimize a portfolio by making sure they're on those momentum horses. Optimizing is another way of saying momentum investing, trying to do exactly what the market is suggesting you should do at that particular time. But the flip side of that, in her words, are in good times, optimizing might seem like the obvious approach. But when times turn bad, I think you'll thank yourself for having built in more room for error instead. This is a long-winded way of me saying, don't fret if your portfolio hasn't rebounded as much as the market over the past couple weeks. Nor should you fret if you're doing a little bit worse than the S&P 500 for the year, which may be the case because some of the bond markets are down, small cap stocks are down. Certainly a number of sectors within the S&P are still down for the year, like healthcare. A lot of the big Magnificent Seven names are down double digits year to date. Don't fret about that. Understand that this is a process. You're not trying to generate, if you have a long-term portfolio, I don't know that you're trying to win every monthly battle, right? You're not trying to win every weekly battle. You're trying to win the war. So, wanted to make sure I made that point. I would also say that even though the extent of this bounce has been greater than what a lot of people anticipated, it's still, not only is it within historical precedent, we have seen it before, certainly saw it during COVID, coming out of COVID, but the next phase I think is still likely to unfold, which is kind of a grinding phase, and we certainly saw a lot of that this week, right? Look at the sentiment. We went from thinking that the world was falling apart in April when tariffs came out and were much more draconian than what anybody anticipated, to now, the consensus is everything's going to be fine. Everything's going to work out. Well, my guess is the truth is somewhere in the middle. All right. So, and the market action this week suggests that might be the trading pattern, at least for some period of time, where we have some good days, we have some bad days, maybe we end up a little bit lower, but maybe we don't get those big waterfall sells and huge, 2, 3, 4% rallies either. So we'll see. We'll see. Certainly, if you're looking at catalysts for the bounce, de-escalation with China was probably the biggest one, right? We had a punitive 145% tariff rate on China. It was reduced to 30% with a 90-day pause. There's still, of course, no trade deal with China, but just that pause was reason enough for people to sort of take some of those worst-case scenarios off the table. And some other things have happened as well. I think, of course, we all know how big of an influence the Magnificent Seven stocks and AI more broadly was on the S&P over the last couple of years. The fact that those companies, for the most part, the big names most associated with AI produced pretty good earnings, not to mention either maintained or actually increased their capital expenditure budgets, that was also, I think, a significant catalyst. All the magnificent names are higher today than they were a month ago. I think going forward, though, what analysts have started to do is remove the percentage odds, or at least reduce the percentage odds of those worst-case scenarios unfolding. And that's probably the big thing, right? I read something from Goldman Sachs where, for the second time this year, they revised their S&P 500 target. So at the beginning of the year, they had a very bullish target. They took that target down in April, and now they've raised it again. And really the reason that they've raised it is they think that the U.S. economy will do better than what they had originally anticipated. Certainly less recession risk, in their words. And they also took up their earnings estimates a little bit. So Goldman Sachs thinks that S&P 500 earnings growth could still be 7% this year and 7% in 2026. So that's better than what they were saying just a few weeks ago. They also think that price-to-earnings multiples will hang in there as well. 30 days ago, they had thought that earnings multiples would drop, that investors would feel less comfortable paying for future earnings. But because, in their words, there's reduced uncertainty, which is a bit of an if, right? I mean, there's still a lot of uncertainty, but maybe there is some reduced uncertainty. Faster earnings growth, according to them. Lower inflation, again, according to them. If you have a more benign tariff environment, you would expect less inflation. And renewed confidence in the fundamentals for the largest stocks in the index, which is what I was saying a minute ago about the Magnificent Seven earnings. So you add all that up, they think that earnings will be a little bit better and that valuations will hang in there. Hopefully they are right about that. But we still obviously have a lot of questions. I'm not going to spend a lot of time on the economy today, but the central question, of course, and I mentioned this 2 weeks ago, will be what happens with jobs. Americans have proven time and time again that if we are working, we will be spending, right? We may not be saving a lot, but we're going to be spending. And we just saw the jobless claims this week, just before I recorded this show. They were still quite resilient. As many jobs were created as was forecasted. So we have not seen at this point any significant layoffs. Even with those DOGE cuts, either those people have not showed up on the unemployment rolls yet, or they're finding other jobs, or they're retiring. We'll see. But it has not showed up yet in the unemployment data. And other sort of real-time data has stayed pretty resilient. Things like TSA data that monitors, the number of people traveling. Restaurant data that shows, are people still, going out and doing things. I think the common thread is that there's been this disconnect between the quote-unquote hard data and the soft data. I've talked about that a lot the last few weeks. This soft data, the sentiment data, is almost as bad as it has ever been. So the April consumer sentiment data was the second worst reading going all the way back to 1952. Second worst reading. That's the University of Michigan sentiment data. But keep in mind, that had not factored in the idea of some de-escalation, some thawing in tensions with China. So maybe it's a little bit better next time. But still, the consumer sentiment data is as bad as it's ever been. But people are saying one thing, and they're doing something else. They might be complaining about the current environment, but they're still going out that night and going to dinner. They're still hopping on a plane and booking a vacation this summer. That's been the pattern so far. We will see if it holds. And of course, another big question is, what are companies going to do with tariffs? The president has been vocally and publicly putting pressure on publicly traded companies as large as Walmart to eat the tariffs, to eat them. But that flies in the face of what the data is saying. There was a survey from the Department of Labor recently that surveyed something like 4,500 companies, both public and private. Almost 60% said that they were going to hike prices and pass along tariffs to consumers. We'll see. I don't think, quite frankly, that the president's jawboning is going to work. I think companies like Walmart are going to do what they have to do to preserve their profit margins. And my guess is tariffs will flow through. But that's a central question for this year, right? Because there are really only two scenarios. If they pass them along, we're all going to pay more for those goods and services. If they don't pass them along, it's going to impact their earnings, their profit margins. So we'll see what happens. Another big variable for the economy, of course, is this tax bill. Just passed the House this week. Now it sits on the desks of the senators. I'm not a political expert, and I know there's a big difference of opinion on the merits of this tax bill. It hurts some people, it helps some people. But from a pure kind of market perspective, the folks at Strategas estimate that taken in aggregate, as it's currently written, it should add about 1% to GDP. Now, the timing is not necessarily matched up with tariffs, right? So tariffs are an immediate impact. Some of the relief may not show up until 2026, okay? So the timing could be a bit of an issue. But again, in kind of base terms, roughly a 1% stimulus, which is not going to solve problems if tariff war escalates or at least persists, but it could help to sterilize some of the negative impacts from tariffs. We'll see how that looks going forward. So that's another big question. And then the other thing I'll just mention briefly on the economic side is, of course, Moody's finally downgraded the rating on U.S. government debt. Now, the obvious question might be, what the heck took them so long? The S&P downgraded the U.S. credit profile 14 years ago, 2011. Fitch, the other rating organization, downgraded in 2023. So you kind of wonder what Moody's has been doing this whole time. I don't think the Moody's downgrade in and of itself is all that impactful, simply because it reflects concerns, if you will, that everybody already knows. I mean, everyone's been talking about. But I do think it sours sentiment, and we certainly saw that this week, where the long bond, the 10-year Treasury, the 30-year Treasury, those yields went up a fair amount this week, and I think some of that is sentiment-driven. So we'll see the extent to which that impacts the economy. That certainly will impact mortgage rates, credit card rates, other types of lending that are tethered to longer-term, Treasury rates. We'll see. We'll see. I think it also reflects the sort of sell America trade, right, that we've seen. So we have to watch what capital flows look like, not just investment flows, but also actual capital expenditure flows. Is there money coming out of the United States and going to other places? We've seen it to an extent. We want to monitor that to see if that accelerates. All right, I'm going to leave that there, sort of the big picture talk. Up next, stick with me. I do have thoughts on a couple individual stocks, one of which is a new name I don't think I've ever discussed before, and a few thoughts on some potential opportunity in the bond market. Stick with me. Back in a minute. The Magnificent Seven have become the Lagnificent Seven. The clear leaders of the past 2 years are now bringing up the rear. Is this just a correction or something worse? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to our Wise Investor Group podcast. Simon Hamilton here. Just want to highlight a few things on the investment side. I mentioned how longer-term interest rates, particularly longer-term treasuries, have been going up recently. But municipal bond market, corporate bond market, yes, they are directionally correlated with treasuries, but they have their own set of nuances. And one of the things that's been very apparent the last couple months is some significant selling in the municipal bond market, the tax-free bond market. And just to refresh your memory, municipal bonds are those issued by municipalities of all sorts. In some cases, they are general obligation bonds backed by tax revenues, like state bonds or city bonds. Sometimes they're backed by revenue sources, like a toll road bond or a prison system or a sewer system bond. In most cases, not all cases, but most cases, the income is federal tax-free, and they can also be state tax-free depending on where you live and where you're buying your bonds. What state are you buying those bonds from? So, as always, when I discuss any sort of investment concept, you have to make sure that you do your own homework if you're not a client. I don't know if these are right for your particular situation. If you are a client and you own some of these asset classes or investments that I'm talking about, you can, I think, feel pretty confident that we've done our due diligence to make sure that they're appropriate for you. I will also say that I'm going to mention a few things today that I own myself in my personal accounts and that we also own for clients. In some cases, you could consider that and maybe should consider that a conflict of interest. But yeah, I just wanted to focus on municipals here for a second. As of about a week ago when I was doing some research and I read some good pieces from Morningstar, Morningstar noted that the average national municipal bond fund was negative for the year. And longer-term municipal bond funds were down almost 2% for the year. This is as of about a week and a half ago, actually, so it's probably worse today. So municipals have underperformed other fixed income asset classes. And they went on to note that municipal bonds have, in their words, only been mispriced two other times, 2008, at the beginning of the financial crisis, and at the onset of the pandemic. In other words, we've seen some dislocation in prices there that you don't often see with municipals, which are considered pretty conservative investments overall. So what's going on there? Some of it, I'm not going to get into all the issues. Some of it is a supply-demand imbalance. Supply is up something like 15% over the same period last year. Secondly, municipals tend to be very thinly traded in many cases. So I think when kind of everything went to hell in a handbasket a few weeks ago, municipals sold off a lot in many cases just because there was a lack of liquidity, a lack of volume. That blew out the spreads on a number of bonds, and that really hasn't recovered very much so far this year. And there's some other factors as well. But the bottom line is, and this is according to Morningstar, local governments are in some of the best fiscal shape in decades. Remember, local budgets, they have to balance those, right? So you could argue that state and local budgets, in many cases, not all cases, but many cases, are in much better shape than our federal balance sheet, right? And according to them, the muni bond market is cheaper than it's been over 95 to 99% of the past 15 years. And they're saying that it makes sense for everybody, regardless of tax bracket. So even if you're not in the max bracket, to own municipals. Those are their words, okay? Now, obviously, whether they're right for you, it should be a nuanced conversation between you and your advisor, okay? I'll make one last point. The yield curve on municipals is steeper than what we're seeing with corporates and treasuries. What I mean by that is, the long-term treasuries are a little over 5%, short-term treasuries a little over 4%. So there's a spread there, but not a huge spread. Corporates, it's a little steeper. With municipals, if you're willing to go out further, 10, 15, 20, or even further years, you're compensated with much higher yields going out further than in the short term. I'm just going to give you a few examples. Full disclosure, these are some bonds that I own in my own account. The caveat is I'm just going to quote you yields as of when I printed these out, which was on Wednesday. Do not take these as gospel because prices change, yields change. There's no guarantee you can get the yields that I'm talking about. There's no guarantee that there's availability in these bonds that I'm talking about. I'm just giving these to you for illustration purposes to get a feel for what I'm talking about. So, for example, I own a West Virginia housing development municipal, AAA rated. It matures in 2043, so has a longer final maturity, but it could be potentially called in 2032, so it could potentially be called in 8 years. Pays a 4.45% coupon, which means that's the interest it's paying you. So for me, I live in Virginia, that would be federally tax-free, not state tax-free. But if you look at the taxable equivalent, I'm not going to tell you what tax bracket I'm in. I'll save that for private conversations. But for those of you who are in the max bracket, the yield to worst, so if they were to call it in 2032, that's equivalent to about a 7.2% taxable bond. That's only 8 years from now. If it goes all the way to that 2043 maturity, that's about a 7.3% taxable equivalent. I don't know if you can find that in the corporate bond world for something that's AAA rated. For something in Virginia, there's a bond that I own from Spotsylvania County, just down the 95, paying 4%, and this would be federal and state tax-free for me because, again, I'm a Virginia resident, AA1/AA plus rated. The next call date is 2034. If they were to recall it in 34, almost an 8.6% taxable equivalent. If it goes to the 2045 maturity, almost 8% taxable equivalent. I'll give you one more. I don't want to belabor the point, but I'll give you one more. I own one that's AAA rated, Virginia State Housing Development Authority, callable 2032, final maturity 30 years from now. It's a long-term bond, 2054. Paying a 4.95% tax-free coupon to me because it's state and federal tax-free to me. Get this, the yield to worst, if they were to call this in 8 years, 8.6% taxable equivalent. If it goes out the next 30 years, hopefully I'm around, 8.6% taxable equivalent. I think you get what I'm saying. You don't have to take on a ton of risk. The three names that I mentioned to you are double and AAA rated. But if you're willing to go out further, you can get taxable equivalents if you're in the max bracket. And if you're not in the tax bracket, obviously you would walk down those yields a bit, but they're still pretty good. You're probably able to get somewhere between 7 and 8, maybe 7 and 8.5% annualized return. Well, is the S&P 500 going to do better than 7 to 8.5% annualized over the next 10, 15, 20 years? I hope so, but no promises of that. Stocks have averaged, roughly 10% over the last 100 years? So if you can get 7, 7.5%, 8% from a highly rated bond, taxable equivalent, at the very least, I think that will be competitive with stock gains over the next 20, 30 years. I know I'm talking in broad strokes, and again, I want to be very careful. I'm not telling you to go out and buy those three bonds. You have to do your own homework, and those prices and yields may not be available today. But you get the illustration that I'm trying to make sure you understand. So take a look at that. I had one name I wanted to cover on the stock side. We were sort of 85, almost 90% of the way through first quarter earnings reporting season, so I don't have as much to share on the individual stock side. But yeah, we have a new name in the portfolio that we've added for a lot of clients. We just started chipping away at it. So if you're a client and you don't have it yet, we're chipping away at it. And if you're not a client, make sure you do your own homework. But I do own this personally as well. The name of the company is Tenet, T-E-N-E-T, Tenet Healthcare Corporation, symbol THC. And Tenet owns and operates a pretty expansive healthcare network. Specifically, they own a lot of hospitals, 60-plus hospitals, but also roughly 500 other types of healthcare facilities, everything from surgical hospitals to ambulatory surgical centers to urgent cares. So they are geographically diverse. They're all over the country. And healthcare has been very challenging recently across the board, whether you're owning managed healthcare, whether you own pharmaceuticals. There's a lot going on politically, of course, not only in the tax bill, but with what Kennedy Jr. and Dr. Oz and others are talking about. We've seen NIH funding cuts. It's been a mess. So this is a volatile space and may continue to be a volatile space, which is probably the biggest risk, by the way, would be any regulatory or policy changes that impact the bottom line of any type of healthcare company. But Tenet has been able to weather this storm, I think, for a number of reasons. One is their execution has been really good. If you look at their most recent quarter, they crushed Wall Street estimates on the top line and the bottom line, mainly due to significantly improved margin performance. So they've essentially completely revamped their portfolio, divested a lot of their lower margin hospitals to focus on growing revenues with what they call high acuity projects, high margin projects. A lot of those ambulatory surgical centers, a lot of those urgent cares are very profitable for them, and they've been focusing on that. And so their margins were a lot better than what people thought. And interestingly enough, they actually did not raise their guidance going forward, which some have postulated that sets them up to maybe outperform estimates going forward. By the way, I drew from a really nice write-up from Deutsche Bank. The Deutsche Bank analyst has been very much on top of the Tenet story for some time, so I think he had some good points to say. A couple other things that I thought were interesting with respect to Tenet is that they actually, according to Deutsche Bank, have the least exposure to Medicaid cuts. So we know that Medicaid cuts are very much a part or potential part of the final tax bill that's currently working its way through Capitol Hill. They have less exposure there than their competitors do. And so that, I think, is a very important concept. They also have a lot of balance sheet optionality. Their leverage has come down a lot. You know, they made some acquisitions, and their balance sheet got a little bloated a couple years ago. They have been paying that down to the extent where Deutsche Bank thinks not only could they make further acquisitions, they could actually undertake a significant share buyback if they wanted to. They also tend to have less exposure to any hits to Obamacare, the so-called exchanges that could come as a result of this tax bill, or just people getting kicked off the exchanges for whatever reason. Only about 7% of their revenues come from the exchanges versus 10% for their closest competitor. Meanwhile, they trade at a slightly cheaper multiple than their next closest competitor. So I think it's an interesting story. It's very much a self-help story where they can really focus on margins and execution as sort of a bottom line level. The risk would be the macro regulatory and policy climate. That's the risk. But as far as execution and balance sheet goes, it looks to me that they're a superior operator. So it's an interesting name for you to think about if you are looking to maybe add some diversification to your healthcare strategy, if you're just sitting in only in pharmaceutical stocks or biotechs, for example, and you want to get more into managed healthcare or hospitals or some other aspects within the healthcare sector. Think about that. Because in general, according to FactSet, healthcare as a sector is trading at its biggest discount relative to the S&P 500 valuation discount since 2001. Since 2001. We've seen what happens when sectors get way too cheap relative to the S&P or way too expensive relative to the S&P. It often sets the table for better or worse performance in the ensuing 2 or 3 years. Just keep that in mind if you're lamenting why healthcare has not done as well as the rest of your portfolio, has actually done worse than the S&P over the course of the last few weeks. All right, I hope that was helpful. Covered a lot of ground today. As always, stay healthy, and I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the WISE Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.